Good afternoon. This is Fred.oltarsh with Libanman Futures, and we're here to discuss back to basics, options, and futures contracts for those solidifying their knowledge base. And I think we all need that from once in a while. So the main concepts we're going to discuss today are futures contracts, calls and puts, the Greeks, and implied volatility. I'm going to run through it a little bit quickly so that we can get it onto YouTube because they have certain time limits. If you have any questions at all, feel free to give me a call. The number is 347-949-4546, and that's my direct number, so you can call me there at any time. So let's move on. Futures and options trading involves significant risk and is not suitable for every investor. Information is obtained from sources believed to be reliable, but is in no way guaranteed. Past results are not indicative of future results. Just to review, futures contracts are contracts or commodities of financially traded contracts with a commitment to take or make delivery at a particular time in the future. The buyer has the right to take delivery. The seller has the obligation to make delivery. If I buy a December futures contract, I would have the right or obligation really to take delivery of gold for the price I paid for it at a contract's expiration. Most futures contracts are never delivered. They are liquidated for those having longs and covered for those having short positions. 98% of contracts traded are never delivered. I've traded for 15 years. I've never taken delivery of a contract, and few people I know have really taken delivery. So nobody has to worry about that. They just have to worry about putting on their positions and liquidating or covering them at the appropriate time. Trading stocks is really like trading futures. Whether you're trading stocks or commodities, the concept is the same. Although there are no dividends in commodities, trading is ultimately based on supply and demand. Trading stocks online is similar to trading commodities online. The adage of buy low and sell high remains. At Libanman Futures, we provide electronic trading platforms that provide easy access to commodities, stock index futures, and currencies, as well as options contracts, my favorites, all in a highly liquid trading environment. Always remember that liquidity is essential for long-term profitability in trading. So that's something that may be in an advanced area, but I'll mention it now. Be sure the contracts you're trading are liquid. Here's an example of a long futures contract. It shows entry point of $77. If you go up, you make money. If you go down, you lose money. In this particular example, it's crude oil. It shows how if you go from $77 to $80, you make a $3,000 profit. The reason that is because crude oil is an 1,000-barrel contract. So it's $1,000 per dollar. Make $3, it's $3,000. When trading futures contracts, understand that each contract has different specifications. Coffee is 37,500 pounds. Cotton is 50,000 pounds. Silver is 5,000 ounces in most cases. They do have different size contracts. Always be aware of what size contract you're trading. Always be aware that you'll need stops to protect your potential losses, and understand where the size of the contract can hurt you and help you. Here's an example of the short futures contract where you have unlimited losses as the prices go higher and unlimited gains as the prices go lower. Understanding the fundamental of options contracts. Examples and verbiage may represent a variety of contracts, but the basic characteristics do not change, no matter what market you're trading. Options are options, whether you're trading in coffee, the mini S&P, the euro, they're all the same. It only depends on the size of the contract. So be sure you really understand it. If you trade one comfortably, you can trade them all comfortably. The dynamics of markets are different, but options contracts are the same. Don't be intimidated by the fact that you choose a diverse number of markets. They all have the same features. Calls. Owning calls gives one the right to take delivery of something. In this case, a futures contract at a particular time and price in the future. The owner has the right, but not obligation, to take delivery. The grantor has the obligation to make delivery. If I owned a December $1,600 call in gold, I would have the right to buy gold for $16 an ounce between now and December expiration. And for that, I pay a premium. That premium is the only worry I have about the investment. If I pay $8 or $8,000 in gold, or $800, I'm sorry, a dollar in gold equals $100. If I paid $800, then my break-even point would be 1608, and I would have no other worries. On the other hand, if I was a seller and collected the $800 premium, I would have unlimited loss potential. Owning puts gives one the right to make delivery of something, in this case a futures contract, at a particular time and price in the futures. The owner has the right to make delivery. The grantor or seller has the obligation to take delivery. If I owned the December $1,000 put in gold, I would have the right to sell gold for $1,000 an ounce between now and December expiration. For that right, again, I pay a premium. Owners of calls and puts excuse me, have the right to take or make delivery of a futures contract at a particular price and time in the future. The seller of the calls and puts have a contractual obligation for the calls to make delivery and for the puts to take delivery of the contract. The owner of a call or put pays a premium for that right. The seller of the call or put collects that premium, but has the obligation for unlimited loss that he takes on. Here's an example of a long crude oil call. In this case, we paid $3,000 for the 77 call. We have unlimited profit potential, and we can only lose the $3,000 we put up for the call. On the short call side, the person sells the call, collects $3,000, sells the 77 call, takes on unlimited risk. If it goes above 80, he's going to lose dollar for dollar as the crude oil goes up. However, anything below 77, and he's taken in the full $3,000 premium. Same thing happens with the puts, only it's a different obligation or right. Here we have the long put paid $3 for the 80 put, and we have unlimited profit potential. And for that unlimited profit potential, we have paid a premium, the $3,000. Anything over $77, we start losing money, and we have a $3,000 potential maximum loss. The short put player is expecting the market to go up and has sold that for the $3,000 premium, and anywhere above 80, they make the maximum of $3,000. Evaluating Greeks. Once you cover the basics options terminology, you are able and ready to analyze simple scenarios with Greeks. The important thing is to have covered and understand the basics that we've just described about being long and being short and potential losses and potential gains. Once you do that, you're ready to move a little bit further. The Greeks are mathematical values which provide key information about the movement of options prices. The definitions are simple, and the numbers are essential to valuing options. The delta refers to the change in the price of the option when compared to the price of the underlying futures contract. For example, an at-the-money call in gold would have a delta of approximately 0.50. This means that for a gold increase in price of $1, the call would increase by 50 cents. Deltas range from 1, which means the call is way in the money and moves in tandem with a futures contract, or 0.01, which means it's way out of the money. It's so far out of the money that it barely moves at all. Vega refers to the change in price of the option when compared to a 1 percentage point move in the implied volatility. We'll discuss that in a little while. For example, an at-the-money call in gold may have a Vega of 50 cents. This means that if the implied volatility went from 17 to 18%, the price of the call would increase by 50 cents. For example, if the call was priced at $8.50 with a 17% implied volatility, and the volatility of the option moved to 18%, the price of the option would go from $8.50 to $9. And that shows that it has a vega of 50 cents. A 1% move in implied volatility caused a 50-cent price move in the option. It's very important to understand that when buying or selling options, because if you sell options and volatility moves 5 points, you want to know how much you're going to lose just on the vega portion of the option. On the counter side, if you're long an option and we're trading 40% and it moves down to 35%, you're going to lose money on the vega, the implied volatility move. And vega is really based on supply and demand. If people come in and sell and sell and sell and sell options, the volatility, or vega, goes lower. Theta refers to the natural decay of an option's price. Theta provides the theoretical overnight decay of an option. For example, if a call option has a price of $8.50 today and has a theta of 15 cents, then if nothing else were to happen and everything else remained the same, the value of the option on the next day would be $8.35. There are many factors that affect theta, including the implied volatility. Gamma refers to the change in the delta of an option when compared to a 100-point move in the underlying futures contract. For example, an at-the-money call in gold may have a gamma of 0.03. This means that if the price of gold went from $1,300 to $1,301, the delta of the at-the-money call would go from 50 to 53. This is the nature of gamma. So if you have a whole portfolio of options and it has a long gamma situation, as the market goes higher, you get longer and longer because your gamma makes your deltas get higher and higher. And this is the beautiful nature of gamma. Implied volatility, while it's not a Greek, it is essential to valuing options. Implied volatility is a mathematical calculation of the value of an option. It creates a relationship that compares all options in a series to determine relative value. The Black-Scholes model and similar models use implied volatility to determine the relative options values. Markets vary in their relationships of calls and puts along the skew. Skew refers to the slope of the options curve for different listed strikes. This, however, is all more complicated and is really not for this short, very brief basic lecture. Keep in mind that the Black-Scholes model won the Nobel Prize for creating this valuable methodology. Now, personally, I'm quite interested in options as a former market maker for 15 years and as head of risk management at the New York Board of Trade ICE Futures. I looked at all this stuff very carefully. And on a nightly basis, I make available information to not only my clients, but people who are interested in this information in the hope that I'll work with you later. Email me to be added to my nightly options packet, which includes settlement prices for both futures and options, deltas, historical implied volatilities, vegas, and volatility changes. It includes periodic trading strategies and moving averages, relative strengths, and other information. Email me at fred.oltarsh at Libanman.com for this information. Just tell me I'm interested in signing up, and I will be happy to add you to the list. I work closely with clients to help them understand the best ways to establish positions to meet their risk-reward profiles. Call me to open an account and see how my background in trading and risk management can help you meet your trading goals. In addition to working as a broker, I provide educational seminars and trading and risk management consulting. You can call me at 347-949-4546 or on my cell phone at 917-656-1767. You can also reach me by email at fred.oltarsh at Libanman.com. I'm sorry that this was such a quick broadcast, but due to the limitations of YouTube, this is all we could provide for today. In the meantime, I want to thank you for attending and encourage you to call me or email me with any questions or comments. I'm happy to help you, and I look forward to speaking with you soon. Have a good day.